Hello, my name is Marco Avellaneda, and I'm submitting this video to IMPA Research and Options 2018 because unfortunately I will not be able to attend the meeting. Uh, this meeting has been going on for, I believe, 12 or 13 years, and I was very happy to be able to attend uh, the meetings either in Angra dos Reis, Búzios, or Rio de Janeiro. So, uh, although I can't go, I decided that perhaps this video could be helpful to have at least a small presence in the conference. Um, this is a very special year because not only we're having another edition of this event, but also we are commemorating the 60th birthday of one of the organizers, my good friend Bruno Dupire. Hello, Bruno, how are you? I understand that you are there with your family and you're probably enjoying Búzios, so I'm a little bit jealous. But anyway, it is a very important event because, as we all know, Bruno is one of the big names and also one of the big contributors to our field, and has had very deep ideas which have impacted um, not only academics but the industry at large of trading and derivatives, and also things that are indirectly related to derivatives. So I wanted to make a small presentation, sort of giving a personal and not rigorous view, but still what I believe to be a way of describing Bruno's contributions to finance from 1994 until now. In 1994, I believe he graduated from PUCI in 1993 or around that time. I'm not sure, but I became aware of his papers in the mid 90s. His paper "Pricing with a Smile," which was contemporaneous with other articles, maybe a little earlier than them, such as Emmanuel Dermont and Zhu trinomial tree or something like that, or implied binomial tree. Anyway, it is interesting after, maybe 30 years or 25 years in options to to see what how people thought about option contracts back in the day, and how they think about them now. Because in the early 90s, people were discovering option pricing, and they were delighted. Early 90s and 80s, I would say, also in the 80s, and they were trying to learn the Black-Scholes formula and the binomial tree of Cox, Ross, and Rubinstein, and understand essentially what would be the fair value of an option contract, which also involved the Greeks. So not only you could price an option, but also you could calculate the sensitivity to the stock price changes. And that was very important because it allowed people for example, make markets and options and hedge risk along the way. So that is how that is where Dupire enters the field, I would say, in those early days of people trying to understand option pricing models. And there was already an understanding that the volatility, or the implied volatility, played a significant role. The legends are the way that people historically think about this is that there was no real volatility skew in the S&P 500 index prior to 1987, which was the famous crash which happened in the United States, and which created a drop of about 15% in one day in the New York Stock Exchange. And all the options exchanges consequently experienced very big dramatic moves, and after which, or as a consequence of which, people understood that out of the money puts should be somehow priced differently than at the money puts, because they corresponded to rare events, and that the rare events have fat tails which are not Gaussian. That is, they're more likely than we would think in terms of standard deviations of the stock price movement. Based on that, there was talk about the volatility smile, or that is the difference between in the money and out of the money options. So many questions were derived around that notion of volatility smile and skew, sometimes called skew also in options, in equity options. So that is what where Dupire comes in, and Dupire basically um, noticed that the skew is essentially labeling different contracts with different implied volatilities to be able to reflect the market. So in other words, people were interested in the translation between the implied volatility, the prices, and implied volatilities of options. Uh, but somehow there needed to be more said than that because, for example, could implied volatilities take any shape and form? And, you know, are there any kind of arbitrage opportunities, or is the market able to mark volatilities anywhere and charge any implied volatilities? Well, there's where Bruno Dupire notices that that in terms of pricing theory, derivatives contracts must satisfy certain no arbitrage conditions. There should not be any portfolios which provide a profit when you enter in the position and have no risk thereafter. And the only way this could be the no arbitrage condition means that there is an underlying probability measure, which is not log normal, not necessarily log normal, which reproduces the prices, or if you like, the implied volatilities of of a screen of instruments, assuming mid-market prices and other assumptions to simplify a little bit. So Bruno basically provided an algorithm which basically found such a probability measure, which is a probability measure in path space. So now we could be thinking of trajectories of prices and how these trajectories, with their volatility, which would change across time and space, would be able to price the entire uh, option universe across different series. And this was new. It kind of generalizes a result of Breeden and Litzenberger, which said that, a necessary and sufficient condition for no arbitrage, if you just look at one slice of options, is the convexity and monotonicity of the option price. Put or call must decrease in strike and must be convex functions of the strike. But this was basically giving you a picture where you actually were able to have something called the local volatility models, which were models where the volatility was not the implied volatility of the option, but was a volatility function which was consistent with the option prices and with the observed volatility surface. That was a very, very big earth-shattering moment because both for mathematicians and for the market. And many people worked in trying to essentially fit these diffusion processes to price, to calibrate them, if you will, or estimating them in such a way that they fit a particular option market. Now, uh, why is this important? this is kind of important because it solves, um, it has applications, both theoretical and practical applications. More conceptually, you could say this provides a conceptual view of option markets because it says it really, you're really looking for what is the option market telling me? When I look at option prices, what are, first of all, assuming that there's no arbitrage, which probably there isn't, what is it telling me about the risk appetite of the market? What is it implying? Uh, for example, one of the things that people often don't know, but it's true, is that options, for example, implied future dividend expectations on the stock. This is something quite interesting, and that is through the mechanism of put call parity. But what Dupire said, it's also implying risk expectations uh, for the stock and incorporated into a pricing mechanism which uh, incorporates the views of the market as a whole or the market makers, and it provides therefore a more complete picture than if you were just looking at one or two options, uh, or options around the strike that you're interested in. Uh, Furthermore, that's kind of at the more theoretical level. At the practical level, you have to historically understand that the mid 90s was the real start of something called structured products, sometimes called exotic options. Okay, even though these are not instruments, so the investment banking and the trading in the, in those days, used derivatives to create bespoke instruments for end users. We call them end users, or clients who wish to hedge exposures that were bespoke to their situation. For example, barrier options. You wanted to perhaps buy a call, but you did not want to, you wanted to buy a call, of course, with your own maturity and strike, but you also maybe didn't want the full call, but you just wanted a call. You wanted a call, but you didn't want to experience the downside of the call. So you would structure it so that it had a lower barrier. So it was an up and out, so-called down and out. Other people said, no, I want a call, but I want it cheap. So maybe I should. I know that I only want protection up to this level, so I can have an upper barrier. There were also something called average price options, lookbacks, um, all sorts of instruments, corridors, collars, accrual options. And these were often packaged um, in some deal at zero cost and created some complicated products that required the skills of people who knew what Dupire had invented, which is called the diffusion processes, which are calibrated to option markets. So that sort of created a explosion in the field of structured products, since banks or trading houses could give quotes to clients of what these structured products should be worth, and would be able to price them quite competitively, referencing, using as information the listed option markets. This would work in foreign exchange, in equities, of course, and in fixed income to some extent um, also. And so here's what's interesting is that, of course, the Dupire implied volatility surface is not the the Dupire implied volatility model is not unique as a model that fits the market, but it is unique if the market is complete. In other words, if there's an option in every strike and so forth. So in markets where there exists a lot of prices, such as index options or particularly index options, the Dupire mechanism was very good to create derivatives which were quite complex and which reference indices. The same thing for currencies, because currencies, there are a lot of data points also in the. So the important thing at that point was something called the vanilla market. So there was the exotic market and the vanilla market. So the Dupire theory was sort of interpreted as a way of taking the vanilla market and using it to value options which were exotic, and not only value them but also through sensitivity analysis calculate the Greeks and also the essentially the vega risk or the volatility risk uh, in different points, in different levels of the surface, which could then be offset by vanilla options. So basically, we have a situation where a person could ask for a quote on a double barrier option on a European index or an American index, or a double barrier option on a currency pair, say Deutschmark versus dollars, which was before the European Union, and then people would confidently make a quote with the barriers and everything, and that quote was sophisticated in the sense that it took into account the value of the option contracts in the vanilla space, so standard option contracts, and not only used a constant volatility like you find in some books at that time. So the idea that the value of a derivative security could depend on the volatility of certain places, traders may have known about it, but they had no way of actually making it precise. And what the Dupire implied volatility model, the local volatility model, does is it provides um, a conceptual framework for relating the plain vanilla option market to the exotic market. All right, so this was very important, and this structured product, golden age of structured products, basically went from 1995, let's say, until the mid 2000s. And it's important to say that the business of structured products started diminishing in the so there was less business in structured products and more business in flow products or in vanilla options, mostly because the structured products were too bespoke and therefore did not have enough competitive pricing, so we say, and if they were also over the counter. And the over the counter market, over the counter means they're not cleared in an exchange, but they're bilateral contracts between a dealer and an end user. The problem sometimes with structured products is if the end user wants to exit the product because it no longer suits his or her needs, then they couldn't do it because they were in a bilateral situation, and the dealer would not be able to give them a fair market. Usually, it had to do something. We're think here about the Asian flu, the 1990, the end of the 90s, the beginning of the 2000, the dot-com bubble, etc. So, the market started moving more towards a more conceptual view of options, but back to options as what we call a flow product, a market which is liquid, everybody can get in and out easy. So structured products were less popular beginning in the early 2000s, and vanilla products became more, the appetite for vanilla products improved. In addition to that, what happened in the year in those early 20th, 21st century days was this surge of interest in another type of structured product called variance products. So the variance products is essentially a swap, which you trade a constant price, a constant amount versus the realized volatility of a certain asset. And here, it is clear that the Dupire vision of the market was very useful. And I am told that he was one of the proponents of the implied variance formula, at the same time that Whaley and other academics published that formula in England. And he was a user of the formula when he was working in Banque Paribas in London as head of the equity derivatives desk. And so therefore, anyway, variance products became important. And the variance is very interesting because it really puts the emphasis on Vega risk and on the risk that structured products or the remaining structured products had on Vega. So in a sense, the structured products changed from the 90s to 2000. Maybe that's the best way to say it. The barrier-like double barrier knockout disappeared a little bit. And then what we had is more, with the advent of the European Union, French and Belgian and German and Dutch banks and Spanish banks, who were retail banks but large banks, were able to offer savings products to their networks based on options, embedded options. For instance, what they used to call the principal guaranteed. A principal guaranteed product means you basically invest a fixed amount and receive the return. You get your principal investment back, plus potentially you participate in the stock market, and that's done by embedding into a fixed income instrument, into a note, a coupon that depends on that has an option like payoff. Of course, these things were sold wildly, which made the dealers and the banks basically were short volatility. They were short Vega. So the idea of macro hedging Vega by 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 using variance or using, for example, by essentially by using some sort of uh, implied volatility, long dated implied volatility, which is what the variance contract would give you, or the market volatility. People were able to, so banks were basically buyers of Vega, and then that created a market of variance swaps and correlation swaps, because the volatility of an index is related to the correlation of the components of the index, and therefore an entire sector of the equity derivatives market was trading variance swaps and trading at different maturities, and prices were being made, and so on and so forth. That actually even went down to the level of the single stocks. Like, for example, in 2005, it was possible to get a quote on a variance swap on a stock like Apple, or like IBM, or Total, so Petrobras. So the idea is that the variance swaps. This was very much an idea that was born in the 90s, and which people like Dupire and other academics at the time had put it out there. Perhaps the academics, at least, not really seeing the consequence that this conceptual view of implied variance by the market might have. Well, as things have it, one of the shortest maturities is the 30-day maturity. It's like 1 month, and the 30-day implied variance was made into an exchange traded was made into an index, and this index is the famous VIX volatility index from the Chicago Board of Options Exchange. The VIX is essentially the the volatility, or the square root, if you like, of the implied variance for 30-day S&P market using all the options in the S&P, and it's often known as the fear index because when the VIX goes up, you know, the VIX is connected with the options of the S&P. The 30-day options in the S&P are essentially insurance for the next month. They are you can think of them as puts and calls, especially the puts or the calls by conversion. Out of the money puts, they provide protection for portfolio managers. So, for instance, recent events show that if you had puts in February or in October of 2018, when the market fell 8%, 10%, you would really see how this insurance help your portfolio in the sense that you remained long the market, but the puts actually hedged you. They made up for any money that you lost and then some because they worked as insurance. But that insurance, and this is what's kind of interesting for the academics, the price of that insurance is not a constant, but it's rather volatile itself. So, so one of the things that then the market started looking at is essentially the volatility of volatility, right? The variations of VIX or the variations of the option values at a fixed maturity depend on the volatility of volatility. And we have had in IMPA many conferences on volatility of volatility that were very interesting. I think of Guillon, I think of in particular of Julien Guillon and others, which gave us a lot of insight on that, because in a sense it's like looking at Dupire's model, but Dupire's model, instead of being a snapshot, an interpolation, if you like, of the prices today, you can see how the Dupire model varies in time as the implied volatilities change in time. So this is all it's a very summarized version of Bruno's immense contribution to the field. But I would just say that things like variance products and VIX now form one of the largest traded, it's called the Volatility Complex. And a lot of people, including myself, tend to specialize just in looking at the Volatility Complex, which means the S&P options, the VIX, the VIX ETFs and ETNs, and also the VIX futures. The VIX futures, I've given a couple of talks in IMPA about that, and these instruments are all based on these early 90s formulas that were known to Dupire and others, and that first gave rise to the models that were used to quote variance swaps, and now give rise to the trading of this index, of the variance index, which also is a way of indirectly hedging against movements in the underlying market. There are also options on VIX, on the VIX ETFs. So it's an interesting complex. And the study of volatility and of volatility models continues to be extremely active. For instance, one of the innovations is the so-called rough volatility. The rough volatility is a model that claims that using fractional Brownian motion, which essentially is a Gaussian process with a fat tail, with some memory attached to it, reproduces better certain features of the volatility market that the so-called Markov or local volatility models have. So in a sense, I would say that also there are other issues, like for example, the stability of local volatility models in terms of their estimation as markets move, and so on and so forth. So I would say that one of the greatest contributions of Bruno in the field was to provide us with an easy to understand approach to translate option markets into diffusion processes. And these diffusion processes are not unique, but we, in a sense, everybody tries to beat the classic uh, local volatility model of Bruno. So, in a sense, his contribution ushered in lots and lots and lots of very interesting papers and ideas of others, which aimed at either making the estimation of the parameters of the Dupire model easier, or perhaps at modeling better, things like stochastic volatility, that stochastic volatility models, or the compromise, the local stochastic volatility models that we all know. In a sense, everybody's trying to find a way of capturing better the the capturing better how to understand and conceptualize option markets, and and I think this field will continue. Uh, and thanks to Dupire, we were able to make a lot of work in the lab. He gave us a lot of work to do, and people continue with that, and options continue being extremely active as trading instruments. However, it has to be said that the way they trade now is very, very different than the way they traded in 1994. It's mostly computer driven. So a lot of these models are also that compete with Dupire, or that try to improve Dupire or translate Dupire into the real world, have to face the fact that they have to be coded, they have to be run in real time, and so they have to work very, very fast. And that is where we are right now. We are in a world where somehow machines are taking over a lot of the human functions, especially when it comes to liquid listed products in the market. So I think this is pretty much what I can tell you. I know it's a very schematic view, but I think we can all appreciate the great contribution of Bruno Dupire. And I think the last thing I have to say is happy 60th birthday, Bruno, and enjoy the conference. And thank you very much for listening.